Imagine knowing exactly when big, institutional players are moving the markets. That's the essence of smart money concepts. By understanding their behavior, you align your decisions with the pros, not against them. Today we'll simplify these concepts, turning complex charts into friendly, actionable insights for you as a beginner in trading. To start, smart money refers to financial institutions with immense resources, like banks or hedge funds. They leave subtle footprints in price movements, visible to those who know where to look. Spotting these signs helps traders align their entries with confidence, minimizing risk and improving potential outcomes. Here's how it works. Institutions create predictable patterns by accumulating or distributing positions. This is where concepts like support, resistance, and liquidity zones come in. Visualizing these zones helps you see where smart money might act next, guiding your entries with precision. One key strategy is observing false breakouts, also known as liquidity traps. Institutions often trigger these to shake out smaller traders. Recognizing this tactic lets you stay calm while others exit in panic, positioning yourself precisely where real moves are about to begin. Support and resistance levels aren't random. They're like psychological fences institutions use to guide price behavior. Knowing when these levels are likely to hold or break helps you make calculated decisions instead of guesses. Let's break this down visually for easy understanding. The Wyckoff theory is another tool that simplifies smart money movements. It deciphers price cycles like accumulation, markup, and distribution. This method isn't exclusive to experts. With clear examples like those we'll share today, it becomes an indispensable framework in your toolkit. Now, how do you enter trades confidently? The trick is patience. Spot the zones where institutions accumulate or create liquidity. Wait for confirmation, price rejection, volume spikes, or false breaks before taking action. This strategy keeps your plan calculated, not impulsive. Risk management isn't optional. It's the backbone of smart money trading. Even the best analysis fails without proper stop-loss levels. Treat each trade as a calculated opportunity, not a gamble. This is how institutional thinking translates into lasting success for retail traders too. The journey to mastering smart money is gradual but rewarding. Focus on learning one concept at a time, like spotting liquidity zones or understanding false breakouts. Over time, these strategies build the foundation of confident and consistent trading. Mastery isn't rushed, it's steadily earned. Smart money isn't just a strategy, it's a mindset of trading with patience, precision, and insight. By observing institutional clues and managing risk, you trade alongside the market's giants instead of against them. Start small, stay consistent, and let this approach redefine your journey in trading success.